Let's take a quick look at US oil from a top-down perspective. Before we get into the charts, very quickly, from a fundamental perspective, due to the geopolitical tensions between Hamas and Israel and the risk of Iran getting involved, this is driving oil up, and that is a bullish fundamental on the price. Now, from a technical perspective, what we can identify from a monthly perspective is the market here swept the low, then the market made a shift in structure from a monthly perspective, breaking above the previous high that created the sweep of low. So we have a very important shift in structure from a monthly perspective. The market then made the bullish impulsive move, the corrective move, and we do expect to see the continuation to the upside. What we can also identify from a monthly perspective is we have this area of internal liquidity in the form of this fair value gap around 100. 100 a barrel is a psychological significant level for oil. What we can also identify from the monthly perspective is we have this candle here. The previous monthly candle closed bullish with a wick to fill. This month's candle came down. It's filled the gap, and then I do believe we are going to start to push to the upside, take out these highs, and fill in the wick. If we now drop down to the weekly time frame, what we can identify from a weekly perspective is since April, the market is in a weekly uptrend, making a series of higher highs and higher lows. If you take your Fibonacci from the recent low to high that broke structure, you can see that the market, since making the impulsive move, made the retracement move, retested previous resistance as support and has started to make the continuation to the upside. So the weekly time frame is aligning with the monthly. The weekly and the monthly are aligning with the fundamentals. Now let's drop down to the daily. Now from a daily perspective, what we can identify, again, the market's made the impulse, the market's made the bullish break of structure. Then the market made the retracement into this imbalance, into the fib levels, and has started to make the continuation to the upside. Like I've said already, we had an imbalance at the psychological of 100, which is my upside target. What we can also do is use the Fibonacci. If we take the fib from the low to the high of the corrective move, the minus 0.272 can be the upside target, which, as you can see, gives us a zone of confluence which the market should get attracted into, the fair value gap and the Fibonacci extension. So now if we drop down to the lower time frames, what we can identify is from a 4-hour perspective, the market has started to make a double bottom, then forming the higher highs and the higher lows. So how can we potentially get into a trade? If you look at the 4-hour impulsive move, which has just created the higher high and broke this structure, if you take your Fibonacci from the low to the high, we can now layer on confluence. The market has tapped into the 0.618. The market has also retested this level of daily demand. However, could we see one more push to the downside to create liquidity before the move to the upside? I believe so. Now, why do I believe that? Because if you go to the hourly time frame, on the hourly time frame, we can see that the market is trading rather, inside of this wedge. Now, this wedge is a inducement pattern. If we break the wedge to the downside, okay, and take out this significant low, fill in this imbalance right here, this is where I will be positioning myself to capitalize on the continuation to the upside. Obviously, we have upside targets from a swing perspective of all the way at $98 to $100 a barrel. So that's my analysis on US oil, patiently waiting for this accumulation lows to be taken out and price to fill in this imbalance that has been left behind during the impulsive move, and this aligns us with the fundamentals and the technicals from a higher time frame perspective.